All right, guys, welcome to another episode of the show. Today we have Jeff Burningham, who is the founder and chairman of Peak Capital Partners, a $5 billion real estate investment firm located here in Provo, Utah. He also launched Peak Ventures, now known as Album, which has 3 early stage funds that back the brightest and most inspiring entrepreneurs in Utah and throughout the U.S. And I know that that's just scratching the surface in terms of what you've done and what you do, Jeff. So but I really appreciate you being here.
Oh, yeah. Good to be here, Chase. Thanks for having me.
Yeah, absolutely. Well, the first thing I typically ask my guests, Jeff, is to talk a little bit about your upbringing. So any influential people in your life in childhood or teenage years that helped influence or mold you into who you are today?
Yeah, of course. I mean, none of us are an island, all of us. Nothing happens alone. You know, the firms that we built, both the venture fund and the real estate private equity firm, would have never happened without, hundreds of people rowing in the same direction. And certainly that's true in life as well. So I grew up in Spokane, Washington, and was blessed to have 2 wounded parents, like we all are. They had their issues, and those issues were, passed down to me, which is the case. But grateful for that because, number one, I had 2 parents that tried their best. What else more can we ask for? What else more can we expect than to hopefully have 2 parents that try their best? And then secondly, that wounding allowed me to heal and to grow and to learn. And that's certainly kind of at this midlife. I'm 46 years old, kind of at this midlife stage. And post, I ran for governor here in Utah in 2020. So almost exactly 3 years ago, a little more than 3 years ago, went out of the race. And these last 3 years, I've spent a lot of time in contemplation, meditation, thoughtfulness, certainly just focused on giving back to the community. And it's been good to reflect, to heal, to breathe, to try to do my best. So I'm the oldest of 6 boys. I'm the oldest. I have a little sister who's adopted. I am a quarterback in high school, a point guard, kind of a prototypical, just young, scrappy, hungry guy. Love sports so much. Growing up, that was my lifeline and my lifeblood through the ups and downs of my adolescence, for sure.
Love it. That's great context. And you went to BYU, is that right?
Okay. Yeah. I actually went to school right outside of Seattle, a smaller school, to play basketball my freshman year.
Okay.
Decided to go on a mission and then transferred to BYU while I was on my mission or whatever. I actually landed home in Spokane, July 4th, 1998. And then I think like August 10th, 1998, jumped on a plane to go to the Jerusalem Center, studied at the BYU Jerusalem Center for that fall semester of 98, and then came back to BYU, of course. So
got it.
Yeah.
That's great. And what was your mindset going into BYU? I mean, growing up, you were obviously very entrepreneurial throughout your career. Was that your thought process going to BYU? Hey, I want to start a company as soon as I can, or I want to go work for somebody. How'd you approach that?
Yeah, that's a good question. I think that it's funny. I remember on my mission once, did you serve a mission by chance?
Yeah, Southern California.
Southern California, yeah. You had these service opportunities, like every week we'd go. I remember in one area we'd go to an old folks home. And I remember it was in Hendersonville, North Carolina, actually a beautiful place. And I remember when I got transferred and left that area, the owner of the old folks home came up to me and was like, Elder Burningham or Jeff, if you do anything in your life that isn't serving the elderly, like you've missed your calling in life. You've missed what you're meant to do, which I thought was funny because I had never thought of that before and probably never thought of it again. I don't think it is my calling in life. But so the point was I was open to everything. I started a carpet cleaning business when I was like 13 years old. I did that because, again, I'm the oldest of 6 kids. My dad was a middle manager engineer. I was on all-star basketball teams that would travel to tournaments in Phoenix and Vegas, et cetera. And I couldn't really afford to go unless I helped pay. And so I've always been a self-starting entrepreneur. And looking back, it's very clear to me that I'm an entrepreneur and that I should be an entrepreneur looking back in hindsight. But it wasn't that clear to me when I came off my mission. And I teach a class at BYU now. I have 400 or so students. And it's funny, or it's interesting to look at them, to watch them, to remember what it felt like when you weren't sure what you wanted to do. You weren't sure what you wanted to be. And I certainly felt that angst when I came back. So I wasn't clear. It wasn't clear to me that I should be an entrepreneur, although that's something I always kind of kept in the back of my mind. Yeah.
Yeah. Makes sense. Yeah. Makes sense. And so coming out of BYU, I didn't find a ton about your early career, but I do know MindWire was that the kind of the first thing you did, or were there other things prior to that?
Well, that was the first, I guess, notable entrepreneurship venture that I did. That was the summer. Let's see, started the summer. So I had an internship, a really cool internship in Dallas, Texas, drove home through the night. My wife, Sally, had come back to Provo. She had graduated the year earlier and came home a week earlier than I did because she was teaching second grade. And I remember calling her from Albuquerque, New Mexico, which is kind of halfway between Dallas and Provo. And it was our first anniversary, and we were not together, unfortunately. And the truth is I was like eating steak and lobster because my internship was paying for it, which was really nice of them. She's like eating top ramen at our student apartment.
Yeah.
She's such an angel. But I remember saying to her, I think I want to start something. Like, you're teaching second grade. Literally, I think the starting pay was $20,000. It might between $20,000 and $24,000. But that was enough. We had nothing. We didn't know any better. It was all good. And so I said, hey, you're teaching. I have this senior year where I was running the management consulting club with Jamie Dunn, one of my current partners at Peak Capital. Yeah. And so I was interviewing for consulting jobs at McKinsey and Bain, et cetera, but I want to do a startup. So, and I told her, I remember telling her, like, I'm thinking I want to start something up. This is in 2000, so before the .com kind of collapse. And so I drove home dreaming of ideas. And it's funny, when a friend of mine helped me unpack my car, and he's like, hey, and he said, what are you gonna do for work? And I said, I'd love to start a technology company, man. I feel entrepreneurship in my bones. I'm excited about tech. And he said, hey, there's a guy that moved in over the summer who's a developer, who's a programmer, a technical guy. I'm not technical per se. And so anyways, we met, started MindWire, won the BYU, it was called the BYU Business Plan Competition then. It's now the Business Model Competition, but won that and had some success. Hired, I think when I graduated in April of 2001, we had 10 or so employees. So we were paying people, but my partner and I never had taken any money. And I remember, this is a true story, graduated April, 28th, 2001, at the end of April. May 1st, first time we were able to take a couple. I think we each took $2,000. So, and then just kind of grew it from there. So serendipity, synchronicity, whatever you want to say, it all worked out. And it was a fun, really learning experience. Not easy, but it was good. Yeah.
That's great. And what was the product? What was the offering that you guys had?
Yeah, this is actually why we kind of sold the business, is that we were really a web and brand integrator for business, like a web development shop, really. Right. We had some products we built, and I really wanted to productize the business. But my business, and obviously we were too young to understand this, too inexperienced to understand this. But after a couple of years of running that business with my partner, I realized we wanted different things. He loved the kind of, my sense then is that he loved the kind of lifestyle of running a dev shop. We had 10 or 20 programmers. He was the king of that castle. It was fun for him. They gamed at night, which I'm not a gamer. We built cool products for Zions Bank and PowerQuest, other companies here in Utah. But I wanted to I for the last year, I kept bringing product ideas to him because I realized that in an agency model or in a service-based business, you're really constrained, obviously, by time. And I wanted something that would scale. And so I wanted to productize the business. And I brought product idea after product idea to him. I bet, I don't know what, but 10 in a year. And finally realized, and none of them got built. And finally realized, we're not going to build a product. And I couldn't build it, to be honest with you. I couldn't build it alone. And so I said, let's sell the business. Like, you love this kind of lifestyle stuff. We have a potential publicly traded acquirer. I want to keep growing. I want to scale the business. I want to see what's next, so to speak. And so, yeah, we sold the business in February, I think, of 2003. I was, 26 years old. Sold it to a NASDAQ listed company. And it was an interesting, good learning experience. Not all easy, ups and downs, bumps in the road, but it was fun.
Yeah. Amazing. Yeah. So you're 26 years old, you have your first exit. I mean, what was the mentality at that point? And I don't know, how sizable that was for you, but if it was a situation where you're like, hey, I could be done, or I need to parlay this into my next thing. But
yeah.
What was your mindset?
Well, it was definitely, I need to parlay this into my next thing, even if it wasn't for money. I was 26 years old.
A lot of life to live.
I'm 46 now, so that was 20 years ago. Wow. Yeah. And I still feel really young. I think I'm in my midlife, so I still have a lot of time. And take it back even 20 years, I had more time than that. So, so I definitely had to parlay it. It wasn't also an exit where I could retire forever. Yeah. However, for a 26-year-old, it was a significant exit, and I feel really fortunate and blessed to have done that. It was actually a half cash, half stock transaction, which is a good learning experience. I had a 2-year earnout on that stock in the publicly traded company. I think I was at the company for 2 years and a week. I kind of held on for as long as I could, and it wasn't much longer than I needed to earn that stock. And really, to be honest, and this is 20 years ago now, but the stock kind of ended up being worthless. It didn't. The company struggled. We were a little bit of a life raft. Our company was a little bit of a life raft for the company. It wasn't just ours. They acquired several dev shops around the Intermountain West and kind of held on to that capital. And so our company became a little bit of a life raft for the struggling publicly traded business. And again, it wasn't the greatest exit. If I knew what I knew now, I would have done it differently. But hindsight's 20/20, and again, for a 26-year-old kid, it was a great learning experience. I mean, I literally negotiated the sale of my technology company as a 26-year-old, negotiating with the CEO of this publicly traded company, who I think was 52, young 50s, 50, 51, 52, 53. He was a Harvard MBA. I'm a BYU undergrad, 26. So I'm not going to win that negotiation. I'm not going to understand the nuance of exits as well as I should have. And so anyways, it was a mixed bag. Like everything in life is a mixed bag, a double-edged sword. But I feel fortunate, and it was a cool experience. And yeah, my mindset was, sorry, am I talking a lot? I feel like I'm going around.
This is perfect. Love this.
I guess this is long form podcasting, baby.
That's right, long form content.
So buckle up, people. Let's see. My mindset was what am I going to do next? Yeah. What's next? And I wasn't sure, honestly. For those of you, I kind of struggled, or what would be I kind of experimented with things for a couple years, 2 years until we founded Peak Capital, actually. And I had several little things in between there, but nothing, 2 or 3 things, nothing really worked during those 2 years. So that was an interesting time.
Yeah. A little bit of discovery, but I mean, so then going to Peak, I also read you got your MBA at BYU.
Yeah, I did.
Was that kind of during that time period?
It was a couple years later while I was at Peak. I was helping run this $1 billion private equity fund. I was launching Peak Ventures, the first venture fund in the Silicon Slopes in Utah County. Yeah. and I didn't think I was busy. I had 4 little kids or 3. I'm going back a lot here and trying to remember 3 or 4 little kids. And somehow I didn't think I was busy enough. So I got my MBA, which was ridiculous and kind of stupid in hindsight and too much. In fact, I'm writing a book right now. That's what I've been spending a lot of time on. It's probably what I'm most excited about. I'm writing a book, and it's the prologue or preface kind of starts with this story of me in business school being so overwhelmed and wanting to just kind of disappear off the face of the earth. I wasn't suicidal, I'm not, but just disappear because I had so overloaded my life that I had joy. I felt joy almost in nothing because I had just taken on too much. It was my fault. And so anyways.
That's insightful. I'm look forward to read your book. And
I'm
sure there'll
I'm
be
excited.
some great stuff coming from that. So, okay, so you're 26, 27, take a few years to kind of figure things out. You're getting your MBA. So I'd love to hear about Peak, right? So you and your partners, how going from tech to real estate. Yeah, just love to hear kind of the early days there, how you guys met, how you put it together.
Yeah, I'll try to keep it brief. I don't know if it's that interesting. I mean, it's super interesting to me. It's my life. It's very personal. But the way it came together is all along. One of my best friends was Jamie Dunn. We ran the management consulting club together at BYU. He went to Bain and Company in Dallas, Texas, then got an MBA at Wharton. We continued to stay in touch all along that time. He knew a little bit about my technology company and the exit. And when after I sold that, I invested all the capital that I received into real estate and actually did really well because this is in 03, 04, 05. But I personally, and this is something that I think I'm good at, is I had a little bit of a sixth sense that the appreciation in the market obviously could not sustain itself. Again, hindsight makes this very clear, but this was not clear when you were living it. When we were living it, it felt kind of the feeling was everything is going to go up and up and up. Everyone's a real estate investor. Literally your waiters at, when you're going out to dinner, I'm investing in real estate. I just bought a spec home or whatever. It's just like, oh man, this is not going to end well. And so I started talking to Jamie, hey, let's buy some distressed real estate when there's a correction. I thought there would be a correction. After it took a little convincing, he was working for a developer in North Carolina, and I don't know. I don't think he saw it as clearly as I did at that time. And but then began to feel it, and he said, let's do it. And hey, I know this super sharp guy, Jeff Danley. Jeff went to Dartmouth. Jamie and he met while they were at business school. And he said, you should meet him. So Jeff and I had met him before. Jeff and I had lunch at Thanksgiving Point, one of the most consequential lunches of my life. It was an awesome lunch. Jeff Danley is one of the greatest guys in the world, one of the smartest guys, and a good guy. And I drove away from that. And I think Jamie, if he were here, he would tell the story that we both literally jumped in our cars, called him. I think he was in a meeting. We both left him a message saying, Jeff Danley said, I love Jeff Burningham. We'd be a good fit. And I said, I love Jeff Danley. We'd be good. Let's do this. And so we started it up. And I was the only one here in Utah. So again, I kind of held down the ship here for 6 months to a year, I think, and got things going. Jeff Danley was working for a real estate developer in California. He moved to Utah. And then maybe a year after that, so maybe 2 years after we started, again, I'm giving rough math, Jamie moved from North Carolina and we were all in. We almost didn't make it. We had no idea how devastating and how bad the downturn would be. We just didn't know. Literally, we go in the office and the headlines of those days. How old are you?
I'm
Jason?
31.
31. So 15 years. So how old are you when this is happening? You're you're in your high school or something.
Yeah, 15, 16, yeah.
Yeah. So you're in high school, but we'd go into the office and literally Lehman Brothers is failing. AIG goes under. It was doomsday. And we were young. We were unproven. we didn't do a deal for 3 years. I'm speaking generally. And we almost didn't make it. We didn't have cash. We kind of, I had some cash from my exit and kind of helped us get through that. And Jeff and Jamie had some savings as well, but maybe weren't as patient as I could be because they hadn't had an exit. They had MBA debt, Ivy League MBA debt. And the truth is they were kind of, unbeknownst to me at the time, they were kind of looking for jobs. And I think January of 2009 when we closed our first apartment deal, Elk Meadows in Park City, Utah. And that was the first deal, and it turned around quite quickly from there. At first, we weren't totally focused on apartments, but pretty soon thereafter got really focused on apartments. And since then have bought, I don't know the numbers exactly, but I don't know, $6 to $8 billion worth of apartments. I think we currently own 4 to 5 billion. About 30,000 units across the country. We have a management company with about 1,000 employees that manages all those units. It was a fun ride, man. I always enjoy the come up. You're like starting the come up now, or you're in it, right? Yeah. Enjoy the come up because, of course, the outcome is great and it's fun to win, fun to grow a big company, fun to employ people. But the come up is really special. So don't miss the come up. To any entrepreneurs out there who are struggling, who are in the grind, cliches are cliche for a reason, but the joy really is in the journey, looking back. So if you're missing the joy as you go through it, I think you might be doing it wrong.
I love that you said that, Jeff. And everything you just said resonates so much with us. I mean, we're going through the same exact thing right now where we started, a year ago when, the market is not great. I mean, deals are not getting done. Yeah. Rates are through the roof.
Interest rates, yep.
And it has been way harder than we anticipated. Because similar to you guys, it was like, we see a little bit of a lull in the market. Yeah. We're coming off the tops. Let's start a real estate investment company. And it's been very challenging, but great. We're grateful to be able to have gotten a couple deals done in the last year. But so I did want to talk. Oh, go ahead.
Well, if you can stick it out, being a contrarian often pays off. Like starting in down markets, like we did, and like you are. If you can hold on, if you can stick through it, it often pays off to be a contrarian.
Yeah, that's our hope. I do want to talk a little bit about, that up and coming, like you mentioned, a little bit more, because I think it's such an important part of any entrepreneurial journey is taking that leap. What is that really like for that first few years? And so, yeah, I mean, for you guys not having done a deal, it sounds like for a couple of years or 3 years at least. I mean, what were you guys doing during that time? Was it focusing on building investors? Was it sourcing deals? Were you working part-time jobs? Was everyone just in the office every day?
Everyone was in. We weren't working part-time jobs. Once everyone came here, we weren't. Yeah. Jeff and Jamie took a while to kind of wind down their other job and get here. I was doing this pretty much full-time, although I had some things to wind down as well, some small things I had started during those 2 years. We were all in it, and really, I'm a strong believer in momentum in life, like the flywheel effect. Dude, and we were hustling. We were working our butts off. We were establishing broker relationships in markets that we liked. We were establishing, and I kind of let out or did a lot of this. We were establishing investor relations, and all of us had a different network. With some of our key investors actually were contacts from business school of Jeff and Jamie's, and so we were establishing investor contacts. We were trying to cultivate a team or start to look for people. We've had a great internship program out of BYU since the beginning almost. It's an interesting internship in finance, both in real estate and in venture. But so we were setting up that pipeline. We were looking at deals in all the markets we love. We were learning, I think, how to underwrite deals. And so anyways, we were busy. And I think a lot of we were building success without knowing it. Like we were doing the work the first 3 to 5 years. We were grinding away without understanding the power of the momentum that we were building, which I think is often the case in entrepreneurship. You can't really see it when you're in it. Like it takes some time or in hindsight, only is it clear kind of what you were building and how powerful that momentum can be.
Yeah, I love that. And on that first deal you mentioned in Park City, maybe tell us a little bit about that. What was the size? What was the raise that you guys had to put together? And did that give you guys some income or some fees to live to fight another day?
It did, yeah. I don't remember the details and I don't want to misquote it, but it was about 100 units and I don't know, $2 to $5 million in equity raised. I can't remember, to be honest with you. but I mean, significant for a first deal and for a young group of guys, but not now, honestly, very insignificant in size. But yeah, it provided us hope. And by the way, it kind of started cascading pretty quickly. We bought Elk Meadows and then another, I think 2 or 3 deals in Utah in the coming couple months. I mean, it started working after that. And so, yeah.
Yeah, and I want to talk a little bit more about that snowball effect, because the first one's always the hardest, right?
Yeah.
And then as you subsequently go. So, what were the next couple of years like in terms of growth, raising capital? You guys, I think, stayed a direct deal model for some time.
Yeah.
But yeah, what were the first 5 years like for you guys? Yeah,
just again, we were doing the things I spoke about: establishing broker relationships, understanding markets, investor relations. We had our first deals, and still to this day, a lot of our deals are just high net worth direct deals. We also now have funds, 3 or 4 direct funds that we invest out of, hundreds of millions of dollars each. But the direct deal model still is part of our business model. And was the bread and butter for the first, decade. I don't know, man, it might 5 to 10 years.
Yeah.
And so yeah, we had some of the who's who of, Utah high net worth people believe in us early. Fraser Bullock is a good friend of mine, the founder of Sorensen Capital, the COO of the Winter Olympics when it was here 20 years ago, I guess now. A great guy, lives in Alpine. He was an early investor, an early believer. Grateful for him, and so many others actually, people that are now friends of mine that are kind of the who's who of high net worth investors and people here in Utah.
Yeah, that's great.
Yeah.
When it comes to product type, you mentioned you initially explored some other products.
Yeah.
Why settle on multifamily?
Yeah, so much diversification. Again, we house 30,000 families. So you think of retail, or you think of even industrial or office. Someone goes out of business. You have an office building that, let's say there are 3 tenants. Someone goes out of business or decides to move or has to grow, or like you just lost a 30-year income. We have 30,000 families that provide massive diversification along the portfolio. Number one. Number two, obviously another great thing from a financial standpoint about apartments is you're adjusting rent. Think of it, if we house 30,000 families, I'm doing rough math here, about 2,800 of those apartments come up for release every year. You're constantly indexing to inflation. You're constantly moving. Instead of locking into a 3 or 5 year office or industrial lease with maybe fixed increases, that's not the case with multifamily. Every 10% of your portfolio rolls over every month, which makes it hard to operate in. And our operating team, our management company, Peak Living, is unbelievable. I'm not good at that. They're great at it. And, that provides a nice hedge against inflation. In an inflationary environment, you're repricing 10% of your portfolio almost every single month.
Yeah, makes sense. Speaking of Peak Living, you guys are vertically integrated, which not everyone is. Yeah. Some groups decide to use third-party property management to get out to different markets, et cetera. But how was that process to create a management company? Yeah. And has that been
That's funny. After, I can't remember, again, after a couple of years, we had some capital, we had done some deals, and I think we had, I don't know, 3,000 to 5,000 units, 5,000 units probably. We're like, let's do a management company. Who has the most time? Maybe Jeff Burningham does. And I went and tried to start a management company, actually with one of my the number one intern. The first intern we ever had at Peak Capital was Grant Collard, the founder of Redstone Residential.
Oh, yeah.
He was my first intern. And we spun out a management company to try to get going, and it failed miserably. I don't remember exactly what happened, but it did not work. It was too early, actually. So you have to have scale to really vertically integrate. And 5,000 units was not enough. I don't think it was a massive failure, and I take responsibility for a lot of that or some of that. Grant was super young and, takes some responsibility as well, and was maybe a little impatient and didn't understand. He's gone on to have great success now, and that's cool with us. We've spun out I don't know how many companies in the lifetime of Peak Capital, some of the guys that we've spun out and their companies.
Yep.
We just keep spinning new companies out, which is great and fine. We want people to be successful and do what they want to do. But so the first foray into management failed, and I was roughly in charge of it, and I failed. But so that was about maybe 5,000 units. And then we did not try again for several years until we were at least 10,000. And we may have been closer to 15,000 units until we launched Peak Living, and it worked. We just had enough scale. We had scale in certain markets because you need operators and managers in markets. And we had enough scale. It worked out. I think I had moved on generally to venture, starting the venture fund. And so Jeff or Jamie, I think it was Jamie to start, kind of did Peak Living, and he's a better operator than I am. And so it was probably smart to have him run the show and not me. And Peak Living struggled. It wasn't easy. It's not easy. There's not a lot of margin, as you know, in management companies, but it's a critical component to managing assets. And it worked the second time, and we have a great CEO now, a woman CEO, Kellyanne Crapo is her name, and she's been there for 5 years, 10 years. She's awesome. And so it's all about a good team, as you know. Usually the best teams win, and so business, life, anything, a political run is about surrounding yourself with the very best people you can, because usually the best teams win. Yeah. And you win as a team and lose as a team.
Yeah, I love that. And so many benefits to having an in-house management company, obviously pros and cons. Everything is a double-edged sword, as you said earlier on. But kudos to you guys for being able to do that. There's
Thanks.
A lot of benefits to that. So going back to your guys' ability to scale so quickly, for us, the biggest bottleneck is raising capital. I mean, that is, I think, to any newer sponsor or newer group, is like, that's, if there was some magic wand to have unlimited source of capital, everyone would be doing a lot more volume. But what strategies or what did you guys do to help grow your investor network? How are you strategic about doing that? To get some of those folks.
I tell my students at BYU, a lot of them come up to me and talked about doing a real estate startup, and I tell them the only barrier to entry really is capital. That's good and bad. It's cool because anyone can be a real estate investor, can own real estate. The bad news is you need money to do it. So the barrier to entry in real estate is capital. And how did we do it? I don't know. We were good guys. We were respected. We served others. We networked. When I say served others, like, we understood that networking was about. We did right by our first investors. One of our first investors, I remember, wrote us $1 million check. And the deal actually didn't even end up being that great, but we kind of saved their capital in a miraculous fashion. A lot of work. Again, kudos to my partners. The next investment they made was 10x that, $10 million. So it was really about building a relationship of trust with people that we already knew. And, grateful for early investors that saw something in us, took a risk on us, believed in us, and gave us a chance to do what we could do, which we could do this well. We just needed the capital in order to be able to kind of prove that. So I don't know. Again, we were well-respected guys, knew a lot of people. Again, Jeff and Jamie were Ivy League MBAs. I had been in the tech scene here in Utah and in business network in general, and so knew a lot of people here, and so we were able to cobble that all together and raise capital.
Makes sense. Yeah. You touched on the fund model versus the direct investment model. What have you seen as the pros and cons for both of those structures in your group?
Yeah. Well, the direct investment model, when you sell an asset, you make money, hopefully. The fund model, you've got to return the fund before you really make money, so you're clubbing deals together. Obviously, the fund allows diversification across a number of assets, whereas one-off deal, you're kind of, if Elk Meadows and Park City hadn't gone well, it didn't go well. You don't have a lot of diversification. So I think there is power, obviously, too, in the market to having the capital, to pricing power, negotiating power, closing power when you have a committed fund. But we continue to invest both out of SPVs or kind of one-off deal vehicles and then out of a fund as well. So I think it's cool to have both, but there are pluses and minuses to each, as you know, or hopefully people know.
Yeah, makes sense. In terms of hiring, I mean, you guys have grown a lot. I will say, I feel like relative to some groups, you've been able to stay relatively lean. It seems like I think there's 30, 40-ish people, at least in-house.
40 people in the investment side of the business. Yeah.
Yeah.
Correct.
So how have you guys, selectively hired? How do you choose the right employees and know how to when to hire as well?
It's a great question. I got kicked out of hiring. There's a lot of things I'm not very good at. I got kicked out of hiring fairly early because everyone, and I'm speaking generally, and when I say fairly early, it was probably 5 to 7 years in. Jamie and Jeff and I interviewed like every single person we hired, all three of us, for like the first 5 to 7 years. But what was so funny, and this shows what an entrepreneur I am and who I am, I would try to convince everyone we interviewed to be an entrepreneur themselves. So I'd be like, if you would have come in, Chase, I would have been like, oh, cool. You should do this on your own, man. Yeah. Like, you don't need us. Like, and eventually, after a couple of years of that, Jeff and Jamie came to me and they're like, why, dude, we want to hire these people and you're convincing them to do things on their own. Like, what are you doing? And so anyways, I'm not claiming that I'm the best at hiring, but I will say that the best teams usually win. It is about the team. And I think you need to know your box when you're hiring. Like, what are you really looking for? What do you really need? And then look for people. I have a bias towards action, personally. I think most entrepreneurs have a bias towards action. I personally look to hire people that have a bias towards action, towards getting things done, being proactive, and making things happen.
Yeah, love that. And in terms of incentivizing people at your firm, every group is different. And I think for somebody being an entrepreneur, I think sometimes it's, well, what's the end game for me as an employee? Is there partnership opportunities? Is there a split of fees or promote? Have you guys been able to, I guess, how have you been able to divvy that up? Is that part of your structure?
Yeah, absolutely. I think we've been pretty good at that. We have pretty good longevity with most of our employees. There have been some up and comers starting with Grant Collard that, like, I don't know, maybe they didn't see or feel enough upside, a couple of the guys too, that have kind of split off. So that's always the challenge with private equity and venture capital is like, how do you run a sustainable, good business while incentivizing the younger team? But I think we've done a fairly good job of that. And yeah, we do share ownership in deals and in the company. And, since I ran for governor in 2020, I agreed to kind of a dilution schedule for myself. Jeff, Jamie, and I were always 1/3 kind of equal partners in everything we did, the venture fund as well as real estate. That changed in 2020 when I ran for governor, which made sense because I made that choice. I was spending full time traveling around the state of Utah. So anyways, things changed. There's different seasons of life and different seasons of business. And
yeah, makes sense. That makes sense. And then in terms of scaling or staying small, I mentioned Cam Gunter had a few other real estate groups, entrepreneurs or CEOs on here. You guys are 30,000 units. You're top 50, probably top 25 owner in the country.
Yeah, I think in the 30s, if I remember right. But yeah.
So if you had to do it again, and maybe you wouldn't do anything differently, but some folks have said, scaling can be more of a headache than a benefit because margins get thinner. You have more overhead. You have this and that. Whereas, and some people are like, maybe it should just be the partners and a handful of employees, and maybe it's not 30,000 units, but it's 5, and you have. I mean, what are your thoughts on that? Yeah,
it's a good question. I feel like you're asking a lot of these questions like with your wheelhouse and interest in mind.
Yeah,
that's exactly what it feels like, which is great. It's all good. It's the super challenge, Chase. Like the balance is between, I guess, lifestyle and cash out versus input in, like sweat and equity in, versus, again, growing a young and hungry team. If you're going to hire and grow a team, there's got to be growth opportunities. So again, we've threaded this needle by not going public. We obviously have had opportunities to go public, to become a REIT. We haven't done that because we don't want to be a publicly traded company. We don't want to have public oversight and financials and blah, blah, blah. So we have stayed small. We have not gone public. However, we have $5 billion in assets is fairly significant. And we have chosen to scale privately kind of as much as we can. Again, and I don't know the numbers. So we're a top 25 to 35 owner in the country of apartments. And so we've grown and we continue to grow, but it's hard. Like right now, like you said, I will say in 2022, we did, I don't know, maybe 85 transactions. So what is that? Almost 2 a week, 1.7 a week. That's buy, seller, refinance. That's busy.
Yeah.
This year, I don't know, we'll do 15 to 20, probably 20. So we're like at 25% volume of what we did last year. How do you oh geez. So the team is humming and growing and making money and having a good time in 2022. Then a macroeconomic environment comes where you can't really control it. You're not really sure. You don't know when it's going to end. You don't know how it's going to go. Yeah, you got to keep your team motivated. You got to keep them excited, and so that's always a balance, man. Yeah. Well, but without the employees we have, without our junior partners in the firm, we couldn't have done what we've done. And we love them. They've stayed. Most of them have stayed super faithful to us. They've stuck with us. I think they've done better than they ever could have imagined. And we, as a firm, Peak Capital, have certainly benefited from their efforts as well.
Makes sense. So shifting to Peak Ventures, I mean, you would have been so busy getting Peak Capital off the ground on the real estate side. What was the catalyst to wanting to get into the venture side?
Yeah, I remember this story like very clearly. So we started Peak Capital in December, I think, 2006. So let's see, that would be 17 years ago. And we started Peak Ventures in 2011 or 12, so 5 or 6 years later. And it was very simple, actually. I remember the conversation. We had a round conference table at our office in Provo, and I remember Jeff, Jamie, and I going like, it's working now. Like there's a little bit of cash flow. We can pay ourselves a little bit, and there's some excess, some extra. What should we do with it? Obviously we were heavily investing in our own real estate deals. From the beginning to today, we co-invest in every deal we do. And so we were heavily investing in our own real estate deals, but we looked around the table and said, we have some extra cash. This is weird and it's good. What should we do? And I said, I know exactly what we should do, guys. There is an oversupply of good entrepreneurs and an undersupply of good capital in the market. Let's start investing in startups. That's kind of some of my background. I did tech before. Jeff Danley had a experience in venture capital on the East Coast in private equity. And so we started making investments. We looked at Scan, Kirk Wiemet, and Garrett G. Mm-hmm. We should have invested in that, but that was one of the first deals we looked at a lot. They ended up selling to Snapchat a couple of years later. Yep. But one of the first deals we did was Owlet. They ended up going public via a SPAC a year or two ago. We were the first investors in Owlet. MX, we were one of the first investors in MX. Anyways, so we started doing one-off deals. And the way it became a fund really was we had real estate investors, LPs, that had heard through the grapevine about the venture deals we were doing and said, guys, let's do venture. We want to invest in venture. And we were like, whoa, this is kind of a side thing for us. Real estate is certainly our focus. But we made the tough decision. I can't remember, but it took 6 to 12 months for Jeff, Jamie, and I to decide, let's launch a fund. Let's do this for quote unquote real. And Jeff Burningham, you're the right guy to do this. Jeff, we don't have to have you anymore on the real estate side. We've raised money. We're performing well. Jeff Danley and Jamie Dunn can hold down the real estate. Jeff, you go run the venture fund. And, obviously there was crossover. We'd have leadership meetings for both and we would all contribute to both. But primarily, I went out and raised a venture fund. And, it was the first institutional venture fund in Utah County. Proud of that. Proud that we've, been the first investor in almost every company going up I-15 from Weave to Podium to Divvy to MX to Owlet to Taxbit to keep going, whatever. And that's created tens of thousands of jobs, high-paying jobs here in Utah and on the Silicon Slopes. And so that's been fun. It was good. It was super cool.
Yeah, amazing. And I asked that question because as being so busy with Peak and deciding to diversify, between the three partners and start a new venture. Because even thinking about handling multifamily and another product type, that's a lot in itself. And so going from multifamily real estate to VC, but you guys made it work, and kudos to you because we're thinking about that too, and trying to get shiny object syndrome as an entrepreneur. It's like, well, we're doing real estate, but wouldn't it be cool if we do tech? But you guys pulled it off.
Yeah, it is. Yeah, I think it's a good point. It's a cautionary tale what you're saying. I agree, but I think you do what you love. I had a passion for venture and tech. Obviously, I started a tech company, and again, there was an undersupply of good capital and oversupply of good entrepreneurs, and so it was just an opportunity in the market that wasn't met. Now there's a ton of venture funds, but like when we launched our first fund in 2013, so 10 years ago, there was not a lot of capital. And so, kind of the market met the moment for us and we capitalized on it. And we're really blessed to back some of the brightest, entrepreneurs in the state of Utah. It's really fun, and outside of the state, but primarily focused in Utah.
And was it a merger with Album? Was that a rebranding?
Yeah, it was just a rebranding.
Okay.
When I ran for governor, we wanted to create some distance between Peak Capital. It was confusing because Peak Capital, Peak Ventures, people would call it Peak Capital Ventures. It's just like a kind of a mess. We knew it was a mess all along, but it was simple at first, and we leveraged kind of Peak Capital's track record to launch Peak Ventures. But once Peak Ventures was growing on its own, once I decided that I was for surely going to run for governor, which I thought of for roughly probably a year before I officially launched, it was just the right time to rebrand the firm. And I want to be clear, like I have not been operating the venture fund for like 4 years now. I know day-to-day, so to speak, operations. The team that I hired is running that, and hopefully continue to make good investments. And the rest is history.
That's great. Well, you're a board member, and we'll wrap up here in just a sec, Jeff, but you're a board member for a lot of these companies, right? What's your role there? Are you being compensated, or is it just because you're an investor? Like how do you allocate your time as a board member?
In the venture fund, it's just because you're an investor, right?
Yeah.
Like, and I'm trying to think if I've gotten any compensation for ever being. I've probably been on 30 to 50 boards in my life, and I'm trying to think if I've ever gotten compensation. I don't think so. Maybe some like options once in a while, but not much. So anyways, and your role totally varies. Your support role, which is the role I'm playing now. We're now investing in venture through our family office. Jeff, Jamie, and I basically, Peak Ventures is basically a family office that we continue to invest in. I think since the governor race, again, this is rough numbers, we could ask Connor, who was my CFO on my campaign and now kind of helps run our family office and our venture investments. But I think we've done close to 100 deals, maybe 75 to 100 deals in the last 3 years.
Wow.
So we're as active as anyone in the state. We've invested as much capital as almost anyone in the state, I think. Am I answering your question? What was your question? Board member, so board members, it depends on what companies need. I mean, you're really at the service of the CEO. You're at the service of the business. And so what I like to do now, honestly, my focus the last 3 years has been on mindfulness, meditation, consciousness, and prioritizing what matters most. And so my point is, I actually like to mentor my CEOs as much in life, really, as in business. And CEOs need it with the mental health crisis facing young people and in our world. They need life advice. They need life coaching. And so do I lean in on the business? Of course, but I'm never going to be the expert in your business. Can I give advice based on experience and patterns that I've seen? Absolutely. But really, the most valuable thing I can do is be a shoulder to cry on. I actually know that I'm doing a good job as a board member when I get the bad calls, like, Jeff, we're running out of money. Jeff, we still don't have product market fit. Jeff, there's a lawsuit. I mean, whatever it is, when entrepreneurs are willing to share the bad news with me, not just the we're crushing it, things are good, blah, blah, blah.
Yeah.
I know that I'm doing a good job. So yeah, I've been on a lot of boards. I'm not on as many right now. I've gone on a couple with minority entrepreneurs that I've been wanting to help and lean into. But I'm being very particular about what I'm spending my time on, especially in business. We only have a limited amount of time, and I'm moving on a little bit in some ways from an active role as a board member, et cetera.
Makes sense. Well, last couple of questions, Jeff. In terms of just general advice for those starting a business or anything that you've learned over your career in the entrepreneurship realm, is there anything that comes to mind that you think would be something you'd like to share to the listeners?
Well, yeah, I mean, a ton of things. Number one, it's always more fun to win as a team. So one of the rules that we had at Peak Ventures is to not really try our best not to invest in solo entrepreneurs. It's hard to do it alone. It's just hard. So we like to invest in teams, choose partners that complement your weaknesses, be self-aware of your strengths, and look for partners where there's synergy, where 1 + 1 = 3 or whatever. Product, it's all about, in technology startups, it's all about product market fit. Really the only thing that matters early in technology startups is product market fit. So everything that you want to do is to search for product market fit. Those are 3 or 4 things that come to mind in general. And look at art, and and look at entrepreneurship. I've been thinking more and more about this as art and adventure. The older I get, the more of an artist I become, or my heart inclines more to artistry. And I actually see building businesses, building companies as a form of art, or it can be a form of artwork. And so I'd encourage young entrepreneurs to take the long view, to look at startups as art and adventure. And do not miss the adventure. Do not miss the come up. Do not miss the joy in the journey.
Such great advice. Well, last question, Jeff. I ask this to all my guests. When you think about life in general, you touch on some of this, but how do you define success, or how do you define a life well lived?
It's a great question, Chase. That's the $1 billion question, right, man? Yes. I think the way that I define that's changing a little bit. But the way that I currently define a life well lived is being true to who you really are, understanding who you really are, accepting who you are, and then leaning into your unique strengths. I believe that we're all here for a reason. There's kind of a purpose in this life. We're trying to progress. We're trying to make progress. Our souls are all wounded, like I said. Meaning our spirit, our souls are all wounded. We all have challenges. We all have struggles. But I think being true to why you are here is the definition of success for me. The second thing I would add to that is being able, and obviously I'm in the fortunate position to be able to do this, being able to spend time on what matters most to you. Since the governor run, I was able to run for governor, partially because some of the business success, which was interesting, hard. We didn't talk about that at all, did we?
No, and yeah, we
can
go into...
No, I don't know. I don't like talking about politics, so it's all good. But like I was able to run for governor because of some of the success. I'm now able to teach at BYU because some of the success. I started a podcast because I had time to do that, called Extraordinary Us, which I have not been recording since I started teaching at BYU. But I'm writing a book, a weird book about AI and how we need to lean into the best of humanity in order to handle AI. And so it's this weird memoirish book about stories of my life and things that I've learned that is hopefully helping us to understand that as more and more jobs get displaced by AI, as information gets harder, the truth gets harder to discern because of disinformation from AI, the real work for us to do as humanity, as people, is to become more conscious, to become more human, to lean into what makes us unique as humans, our emotions, our embodiment, all those type of things. So the point is, I couldn't do any of that. Like if I had to be still concerned about day-to-day expenses. So that's so the best part is, I think success is one, knowing who you are and being that truly authentically, and two, being able to spend time with the people and on the things that matter most to you.
Love it. Well, no better way to end, Jeff. Thank you for sharing your story. Truly insightful. Thank you for the time.
Yeah, Chase, it's good to be with you, man. Good luck. Wishing you all the success in the future.
I appreciate that. Thanks again, Jeff.